So you see the headline, Microsoft's profit skyrockets, a massive 60%. Sounds amazing, right? But then the stock drops. What in the world is going on? Well, in this BGBC analysis, we're going to dig in and find out exactly why.
All right, let's get right into it. On the surface, the numbers Microsoft put out looked absolutely phenomenal.
Just look at this number, a 60%, 60 year-over-year jump in their GAAP net profit. We're talking $38.5 billion. That is the kind of headline that normally has investors popping champagne corks.
And yet, like we said, the stock went down after the report. So that begs the real question, how much of that incredible profit is actually real? How much of it comes from sustainable day-to-day operations?
Okay, and this is where the plot thickens. We have what you could call a tale of two profits. On one side, you've got that flashy 60% GAAP number. But then if you look at the non-GAAP profit, the number that strips out all the one-off, unusual items, that growth is a much more down-to-earth 23%. Still strong, for sure, but a massive difference.
So what explains that huge gap? Well, here's the secret sauce. A $7.6 billion non-cash gain. Think about it this way. This isn't money they got from selling more Office subscriptions. Nope. It's basically just an accounting entry saying their investment in OpenAI is worth a lot more now. It's a gain on paper, not cash in the bank. All right, so that explains the profit illusion. Now let's get to the real story, hiding under all those headlines. And that is the absolutely mind-boggling cost of this AI arms race. Get a load of this number. In just one quarter, that's 3 months, Microsoft spent $37.5 billion on capital expenditures. That is a record. And almost all of that is going towards the picks and shovels of the AI gold rush, GPUs, servers, and data centers. And this chart right here, it just lays it all out, crystal clear. Look, they're generating a ton of cash from their operations, almost $36 billion. But then look at the spending, $37.5 billion. They're actually spending more than they're making from operations. The result? Their free cash flow, the money left over, got squeezed down 9% from last year. What this really tells us is that Microsoft's whole identity is changing. They're not just a software company anymore, selling you a license for Word. They are transforming into the world's biggest AI infrastructure landlord. They're building the digital skyscrapers of the future, and they expect everyone else is going to pay rent. Okay, so they're spending an absolute fortune. As an investor, you have to ask, is this just a giant money pit? Is anyone actually going to pay for all this? Well, to answer that, we have to look at the other side of the equation, the demand. And the answer is a resounding yes. Check this out. Microsoft is sitting on a future order book worth $625 billion. That's contracted revenue they know is coming in. And get this, that number has more than doubled in just 1 year. That is the demand that makes all that crazy spending start to make sense. And we're not just talking about promises for some far-off future either. The money is already starting to roll in. Microsoft 365 Copilot already has 15 million paid subscribers. That's 15 million enterprise seats that companies are paying for right now. But it's not all smooth sailing. This historic investment, this massive order book, it comes with some pretty big risks that we really need to talk about. And here's the catch, the big but. Look at this chart breaking down that huge $625 billion backlog. Almost half of it, 45%, is tied to a single customer, OpenAI. Now that is what you call putting a lot of your eggs in one basket. It's a huge concentration risk. On top of that, Microsoft doesn't have this field all to itself, not by a long shot. The cloud battlefield is heating up. Just look at Google. They're growing their cloud business at a blistering 48% pace. And how are they doing it? By leveraging their own custom-built AI chips to compete aggressively on cost and performance. The competition is absolutely fierce. So you've got this massive spending and these big risks on one side, and this enormous potential and huge order book on the other. How do you square that circle? What's the final verdict here? Well, here's the core conclusion. The market seems to be freaking out about the short-term pain, all that spending. But in doing so, it seems to be completely ignoring the long-term gain, which is that incredible 110% growth in their order book. And because of that disconnect, the stock's valuation, its PE ratio, is actually at a 3-year low. It's in what many analysts would call oversold territory. So let's just sum it all up. Microsoft is going through a period of what you could call AI transition pain. It's tough, and it's incredibly expensive. They're undertaking one of the largest private infrastructure investments in history, sacrificing today's cash flow to convert what used to be software rent into what they hope will be AI computing dividends for decades.
When you look at all the numbers, what you see is a company making an all-in bet on becoming the absolute indispensable foundation of the entire AI era. And so the multi-trillion-dollar question for every investor out there is simple. Will this high-stakes historic gamble ultimately pay off?